In this week's update, the clock is ticking on who controls the straits and the consequences, and what is really driving this amazing US market rally. My name's Gary Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. Lots of volatility, but not a lot has changed across the week. The main feature, of course, was US technology sector, which is just absolutely rocketing away to the upside. So this will be a relatively modest, compact video. So let's get stuck into it. The key point about global markets at the moment are not only equities markets, but currencies and commodities and bond yields is who controls the Strait of Hormuz and what the consequences of that are, because it pretty much controls most things of importance that are going on at the moment. And that couldn't be any more unclear from when we started. So 10 weeks on, and there's really no clarification at all. And there's a couple of different scenarios that can unfold here. One of them is pretty ugly, so we all hope that it doesn't get to that point. But it's affecting global supply chains. It's obviously feeding into inflation, of course, and it is affecting economic growth. And that impact on economic growth will just get more and more pronounced as the time ticks by. And I get a feeling that maybe the next 4 to 6 weeks is kind of crunch point. By the end of June, if we're still in the same position that we're in now, then I think we're really going to start to see the impacts. And look, with some of the supply chain issues, they're already baked in, they're unavoidable, because a lot of those supply chains are pretty empty, particularly seaborne traffic. So the longer that this lingers, the consequences just become more unpredictable, which markets hate, and it creates all sorts of other serious problems. So we all want to hope that this can wrap up in some form or other, even as difficult as it is to see, in the next few weeks, because otherwise things are going to get really ugly. Now, Wall Street is assuming that there is a positive straits outcome for the US. I don't know about you, but I don't think that is particularly likely. But when we get to the US market charts, you'll notice that the huge surge that we've seen is really so much about one particular part of the US market. It's not indicative of the whole US market. But nevertheless, Wall Street is taking a pretty positive view of the eventual outcome here. Now, the US has not been impacted to any great extent so far because they haven't had the energy supply crisis we've had, for instance. But they will be impacted the longer this goes. So that's very much a wait and see. But don't forget, amongst all this uncertainty, the larger structural themes that are going to be progressively stronger and stronger from here to 2030. And it's easy to lose sight of those themes, AI and precious metals and critical metals and robotics and all those areas of the market that are just going to get bigger and better and faster as the next 5 years rolls on. So the extreme volatility can be disturbing for a lot of investors, and it just clouds their view of what they're doing. So it's easy to lose sight of those larger structural themes, but they haven't changed at all, really. Now, important to get all the other advice that you need, be it financial, legal, or any other advice before you take action on anything that is in this video. But suffice to say, my view from quite a few years before the war started to now has not changed at all. I think we've got one of the most exciting opportunities ahead of us that we're ever going to encounter in our investing lifetime. So you want to make sure that you're in a position to make the most of it. Now, if we turn to the American stocks, the S&P was up 2.3 for the week. The NASDAQ, thanks to the technology sector, shot the lights out, 4.5%. That's a big week. That is a really big week. And the Russell 2000 was also up 1.75% as well. So there's some good breadth in the US market. Earnings were very strong, so another really impactful earnings week. large AI tech stocks are the ones that are really driving the earnings surge, but they're by no means the only ones. So this is not a big tech only story. There is a lot of moving parts to this, and there are a lot of technology and technology related stocks. And I think that's the thing to take note of in the States, is just how many of the peripheral beneficiaries of this amazing AI build out are benefiting now. And that was always going to be the case. And that's where a lot of the real value opportunities are presenting themselves. So we've got this incredible capex boom in AI. The large players are now collectively projecting around $700 billion of capex, and all of the ramifications and all of the spin-offs and companies that are going to benefit from that. It really is a massive positive stimulus for the US market. And who knows, it is so broad that it may just carry the whole US market on its back. Hard to know, but it's certainly an opportunity that we're probably not going to see again within our lifetimes. Now, what does trouble me just a little bit, particularly over the last week, is the numerous stocks that are just going absolutely parabolic. It's quite extraordinary. And the last week we've just had was probably the strongest example of that. So that's not ideal, and you would have to assume that the shorter term has a lot of risk in terms of a pullback. And that pullback could be a couple of weeks or could even extend through the middle of the year. We'll just have to wait and see. And this is where your risk management process needs to really kick in so that you're not making emotionally based decisions here. Getting out of stocks just because they've gone parabolic is not the right move. You want to make sure that you're getting out when the balance between buyers and sellers is starting to tip over towards the sellers, because otherwise that parabolic move could double again. We have no way of knowing. So you don't want to take your money off the table too quickly. You need a repeatable process to do this. Turning to the other important data, the US dollar index was down a little bit, 97.84. The 10-year yield also down just a touch, 4.36, and the VIX still sitting around about the 17 mark. So let's get to the all-important charts. This is the NASDAQ composite, and this is the sixth straight week in a row, and it was as strong as we saw a month ago. So that really is an amazing rebound. This is the important gold versus the S&P ratio, and I'm looking for this to turn back up again. Now, given that the US markets indices were so strong during the week, the fact that we were able to turn up a little bit, I take that as a slight positive, but I wouldn't get too excited about gold and silver in the very short term, because we really need to see some sort of pathway forward with resolution of the war, I think, before we're really going to see a rebound in gold and silver. But from a longer term, bigger picture perspective, it's coming. It's definitely coming. The other important chart, this is consumer discretionary versus consumer staples. Not much has happened for that chart during the week. Semiconductors is the leading part of technology. It's not the only part, but that's about as strong as you could possibly get. So that's 6 weeks of consistent outperformance and just going from strength to strength. If we look at the relative comparisons, that's the story pretty much. XLK, which is a very broad sector, but that's just screaming to the upside. Now, that's not sustainable. So we know we're going to get some sort of correction in the near term. So you want to be very careful until we do get that correction. This is the Australian market, and it's really is chalk and cheese. If you look at those accumulation of charts with healthcare getting belted, the ASX 200 really doing nothing, down a little bit. Finance under pressure last week. Information technology and telecoms not doing much. Materials, a little bit of promise, and energy coming off the boil. So that's a very muted picture, the Australian market. But you compare that with that, and it really is a completely separate situation altogether. The S&P obviously looking quite similar to the NASDAQ, but not as robust. XLE has come off and we're in the middle of forming an ABC pullback. Whether it comes back to this sort of 50 to 49 area on XLE remains to be seen, but we're definitely getting a correction now in oil. And there's the Russell. Quick check on the currencies now. US dollar index, not doing a great deal. I've started this on a monthly chart. So we normally look on a daily. So this is a monthly chart, very big picture. And the bottom of this trend channel is 2011. So we've got a rising trend line there for the US dollar. But the point that I'm looking for is if and when, and I think it's definitely a when, the US dollar breaks this long-term trend line that's been in place now for about 15 years. So that'll be a key point here, around about 96, and then a bit lower around about 90. So they're the two key levels for the US dollar. And I think once we break 90, which I think is a high probability looking at it from the fundamental point of view because of the accelerating de-dollarization process that's happening, it's pretty difficult to envisage that the US dollar is going to continue with this strength, to continue with being perceived as a greater safe haven than gold, for instance. It just makes no logical sense at all. But anyway, we'll wait and see. As always, we'll be guided by what the market does. And the Australian dollar, of course, is going the other way. And if we really are entering a commodity super cycle for the next decade, which I believe we are, then you'd have to expect that the Australian dollar trajectory will continue to the upside. So that's the US market. Aussie stocks, our dollar, 72.5. We ended up 0.2% for the week. But sentiment is poor in most sections of our economy. And you've got to say that we're not travelling all that well. That sentiment is pretty well placed. But the commodity super cycle keeps building, so who knows, we might get saved again, as we have done over the last 6, 7, 8 decades, by a super cycle in something. But we could be doing so much better. So the focus for me in Australia remains on stocks that I call immune. For anyone that's not been watching this video over the last few weeks, immune stocks are really those where the outlook doesn't have hardly anything in the way of uncertainty. So stocks that are not immune in the Australian market are obviously ones that are dependent on energy and fuel supply, and that is most of the economy. So let's jump over and have a look at the Aussie market. So the ASX 200 didn't do a lot. We're just holding above this support band, which is between 8,600 and say 8,400. So that's the key support band there. And turning now to precious metals. Gold was up 2.3% for the week to 47.16. In Aussie dollars, that translates to 6,500 in round terms. Silver was up 7% to $80 and is starting to look pretty good. We've got the start of a potential breakout in silver. We'll get to that chart in a minute. Gold is down 15% since the war started, and 43.80 on the downside is a support level. 48.90 on the upside is a resistance level, so they're the key levels to watch. But the odds of a breakout before we actually see some sort of resolution or a perceived resolution to the war in the Middle East are not high, you've got to say. It could happen. There could be other factors that come into play if the US dollar were to fall sharply. But at the moment, on what we can see, that's not the way the market is reacting. The US dollar is really being perceived as a better safe haven than gold. Crazy. GDX was up 5% for the week, so a good solid week for Australian gold producers. And looking globally, ETF inflows have started to surge again after taking a few months off. So the short-term influences that caused gold and gold stocks to go down quite sharply are now subsiding. As happens, the market just gets bored with the extreme volatility. All right, let's look at the precious metals charts. And we'll start with silver because it's the most interesting, and this is on a daily basis. We've got a pretty much textbook pattern. We've got a big ABC correction, so this is the A leg to the downside. then a bounce for the B leg, and then we've headed back down again to complete that ABC correction. It's a very deep one. And because it was so deep and so volatile, we've then entered a period of sideways consolidation, a triangle formation, which we're now just starting to poke the nose above. So this is a pretty key point. This, for me, because we've not broken above this peak of the 17th of April, this is not confirmation yet, but it's certainly preliminary, and we could be getting close to the start of a significant rebound in silver. And I think ultimately we take out the 120 peak that occurred back here in late January. So I think that's where we're headed. Gold not really moving with the same level of volatility as silver. It never does. So we're still in that triangle pattern, and there's the gold price in Australian dollars. And just a quick look at what the Australian gold producers look like. This is GDX, so a bit of a nice rebound there. The pattern looking very similar to gold. And that's GDXJ listed in the States. So that's precious metals. Other commodities, copper really shot higher to $6.25. West Texas Intermediate crude finished around 96. We've got a major pivot point, as you'll see in a minute, on crude oil at around 90. So there's the spot copper chart. So you've got to go back to this massive gap that we got back here at the start of the war. But we've now taken all these highs through here around the 610, 615 mark, taken all them out. That's spot copper at 625. This is crude oil. So an important level here around about 90. And the other one I wanted to show was lithium carbonate is really starting to hit new medium-term to long-term highs as well. So hence the lithium sector is doing pretty well. So wrapping it all up, volatility really is our friend. I know it's a bit disturbing, or a lot disturbing for many investors, because you just don't know what the next outcome is going to be. It causes all sorts of indecision because you haven't really got a game plan. But volatility is definitely our friend, but only for those that have prepared in advance. This is not something that you can do on the run at the time, because all your emotions are engaged with the huge moves in both directions. It's really, really tough to think clearly about what you should be doing. So this is the message that I try to get across every week, that early preparation is absolutely essential. Understand what your longer term endpoint is and work towards that. And that means understanding the weightings that you want to have towards themes and sectors, be that AI or precious metals or whatever it might be. So start with an endpoint in mind. And then what is the composition? Are you going to be more stocks, more commodities, or more ETFs? What are your specific targets in each one of those categories? And this is all related to your personal psychology and what you can tolerate in the market. And then we get down to higher probability entry. So this is just a sequential hierarchy of thought, but it's one that I know that percentage-wise not many investors take the trouble to do, because I think they probably just don't know the answers to most of these questions, and that's absolutely fine. But put yourself in an environment where you can get the answers to those questions is the message. So that's it for this week. I'm sure we'll have another week of stunning headlines, and I'll be back with you next Sunday. Cheers.